What's up, everybody? It's Nismo, and welcome back to the channel where we help you take control of your finances and build long-term wealth. And today we're talking about a technical indicator that can be a complete game changer for your trading Heikin-Ashi. Now, if you're serious about leveling up your trading game and making smarter decisions in the market, you need to understand Heikin-Ashi patterns. Trust me, this is one of those tools that can simplify your charts and make spotting opportunities way easier. And once you get the hang of it, you'll wonder how you ever lived without it. So make sure you stick around to the very end of this video, because I'm breaking down everything you need to know, from basic patterns to more nuanced trading strategies. Let's get started. Alright, so you've probably seen those classic candlestick charts, right? They can be a bit all over the place. That's where Heikin-Ashi comes in. Imagine taking those candlesticks and smoothing them out to get a clearer picture of the trend. That's what Heikin-Ashi does. Now let's talk about a strong uptrend, also known as a bullish run. With Heikin-Ashi, this is super easy to spot. You'll see a series of consecutive green candles, and here's the kicker: little to no lower wicks. Think of it like this: those green candles without lower wicks are like a rocket ship blasting off with no signs of stopping. Buyers are in full control, pushing that price higher and higher. As long as those candles stay green and those wicks stay minimal, that uptrend is looking strong. This is a clear signal that the bulls are in control, and you want to be on the right side of this trade. Now, just like with a strong uptrend, Heikin-Ashi makes it incredibly easy to spot a strong downtrend, or what we call a bearish run. In this scenario, you'll see those candles flip. We're talking consecutive red candles with little to no upper wicks. This is like the opposite of our rocket ship. Instead of blasting off, it's like that rocket is falling back down to earth. That's the power of sellers taking control and pushing the price down. As long as those red candles keep forming and those upper wicks stay tiny or non-existent, that downtrend is showing serious strength. Now keep in mind, just because you see a strong downtrend doesn't mean you should immediately hit the sell button. It's about understanding the context, looking for those confirmation signals, and trading strategically. All right, so we've talked about strong uptrends and downtrends, but what happens when those trends start to lose steam? Well, that's where things get really interesting. With Heikin-Ashi, you can often spot a weakening trend before it even fully reverses. How? Keep an eye out for those candles starting to show wicks on both sides, upper and lower wicks. This is a telltale sign that the market is losing momentum. Remember those rockets we talked about? This is like the rocket fuel starting to run out. It might still be moving, but it's not going up or down with the same force. Think of it like this: those wicks represent indecision in the market. Buyers and sellers are starting to battle it out, and neither side is able to take full control. This is your signal to tighten up your risk management and be extra cautious, because a trend reversal or a period of consolidation might be just around the corner. Now, let's talk about a really interesting Heikin-Ashi pattern that often pops up during times of uncertainty: the doji. This little guy can be a powerful signal, so listen closely. A doji candle is pretty easy to spot. It's a small-bodied candle. It might even look like a plus sign with relatively long upper and lower wicks. So what does this candle tell us? It's basically saying that the buyers and sellers are at a standstill. They're locked in a tug-of-war and neither side is winning. Now here's why the doji is so important. It often signals a potential trend reversal. It's like the market taking a breather, trying to decide which direction it wants to go next. But here's the catch with the doji: you never want to jump the gun. Just because you see a doji doesn't automatically mean a reversal is guaranteed. The key here is to wait for confirmation. Keep a close eye on the next candle that forms after the doji. If that candle confirms the reversal, meaning it's a green candle after a downtrend or a red candle after an uptrend, that's your signal that the market might be shifting gears. Now, let's talk about another candlestick pattern that can provide valuable insights on a Heikin-Ashi chart, the spinning top. This pattern is all about indecision, and it can be a bit of a head-scratcher because it doesn't give us a clear directional bias right away. So what does a spinning top look like? Picture a small candle body similar to the doji, but with one key difference: the upper and lower wicks are roughly equal in length. It's like the market is spinning its wheels, trying to gain traction, but not really going anywhere. Now here's where things get interesting with the spinning top. Unlike the doji, which often hints at a potential reversal, the spinning top can signal either a reversal or a continuation of the existing trend. It's like the market is at a fork in the road and it could go either way. So how do you know what to expect? Well, just like with the doji, confirmation is key. After you spot a spinning top, pay close attention to the next few candles that form. If you see a strong move in either direction, either a series of green candles or red candles, that's your signal that the market has made up its mind and a breakout is happening. All right, now let's dive into one of the most well-known and reliable chart patterns in technical analysis, the head and shoulders pattern. What makes this pattern so powerful is that it can be a strong indicator of a potential trend reversal, especially when it appears on a Heikin-Ashi chart. So how do you spot a head and shoulders pattern? Imagine drawing a line connecting the highs of the recent price action. This is called the neckline. Now, look for three distinct peaks that rise above the neckline. The middle peak, the head, is typically the highest, while the two peaks on either side, the shoulders, are lower. Here's why the head and shoulders pattern is significant. It suggests that an uptrend is losing steam and a reversal to the downside is becoming more likely. Think of it like this. Each peak represents a failed attempt by the buyers to push the price higher. The head, being the highest peak, shows the last burst of bullish momentum before the sellers take over. Now here's how you can use the head and shoulders pattern to your advantage. Once the price breaks below the neckline, and especially if it does so with a strong red Heikin-Ashi candle, that's a strong confirmation signal that the sellers are in control and a downtrend is underway. This is often seen as a prime opportunity to enter a short trade, as the price is likely to continue moving lower. Now that you understand the head and shoulders pattern, let's flip it and talk about its bullish counterpart, the inverse head and shoulders. Just like the regular head and shoulders signals a potential trend reversal from bullish to bearish, the inverse head and shoulders suggests a potential reversal from bearish to bullish. So how do you identify an inverse head and shoulders pattern on a Heikin-Ashi chart? Instead of looking for peaks above a neckline, we're now looking for troughs or valleys below a neckline. Imagine drawing a line connecting the lows of recent price action. That's your neckline. Now look for three distinct lows that dip below the neckline. The middle low, the head, is typically the lowest, while the two lows on either side, the shoulders, are higher. This pattern suggests that a downtrend is losing momentum and a breakout to the upside is becoming more likely. Each low represents a failed attempt by the sellers to push the price lower, with the head marking the last gasp of bearish pressure. Now here's how you can trade the inverse head and shoulders. Once the price breaks above the neckline, and especially if it's accompanied by a strong green Heikin-Ashi candle, that's a powerful confirmation signal that the buyers are back in control and an uptrend could be starting. This breakout is often seen as a good opportunity to enter a long trade, as the price has a higher probability of moving higher from here. All right, let's move on to another important reversal pattern that you'll often see on Heikin-Ashi charts, the double top. This pattern is a classic sign of a potential trend reversal from bullish to bearish. So how can you spot a double top? Imagine the price rallying and hitting a resistance level, then pulling back slightly before rallying again to retest that same resistance level but failing to break through. This creates two distinct peaks at roughly the same price level, forming the double top. The key here is that the second peak fails to make a new high, suggesting that the buyers are losing momentum and the sellers might be ready to take control. Now here's how you can use the double top to your advantage. Keep a close eye on the price action after the second peak. If you start to see bearish signals such as red Heikin-Ashi candles, increasing volume on down moves, or a break below the neckline connecting the two peaks, that's a strong confirmation that the reversal is in play. This is often seen as a good opportunity to enter a short trade, as the price has a higher probability of moving lower from here. Just like we have the double top pattern, which signals a potential bearish reversal, we also have its bullish counterpart, the double bottom. As you might have guessed, the double bottom pattern suggests a potential trend reversal from bearish to bullish. So how can you identify a double bottom on a Heikin-Ashi chart? Imagine the price selling off and hitting a support level, then bouncing back slightly before selling off again to retest that same support level. However, this time it fails to break below that level. This creates two distinct lows at roughly the same price level, forming the double bottom. The key takeaway here is that the second low fails to make a new low, indicating that the sellers are losing momentum and the buyers might be stepping in. Now, here's how you can trade the double bottom pattern. Pay close attention to the price action after the second bottom. If you start to see bullish signals such as green Heikin-Ashi candles, increasing volume on up moves, or a break above the neckline connecting the two bottoms, that's a strong confirmation that the reversal is happening. This is often seen as a favorable opportunity to enter a long trade, as the price is more likely to move higher from this point. Alright, let's move on to triangle patterns. These patterns are some of the most commonly traded chart patterns in technical analysis, and for good reason. They often signal a period of consolidation followed by a significant breakout. The beauty of triangle patterns is that they can occur in both uptrends and downtrends, providing opportunities for both bullish and bearish trades. There are three main types of triangle patterns: ascending triangles, descending triangles, and symmetrical triangles. Let's start with ascending triangles. These patterns form when the price consolidates with higher lows, creating an upward sloping trend line connecting those lows. The upper end of the triangle is usually marked by a horizontal resistance level. Ascending triangles typically signal that the buyers are gaining strength, and a breakout above the resistance level is more likely. Next, we have descending triangles. These patterns are the opposite of ascending triangles. They form when the price consolidates with lower highs, creating a downward sloping trend line connecting those highs. The lower end of the triangle is usually marked by a horizontal support level. Descending triangles typically indicate that the sellers are in control, and a break below the support level is more probable. Finally, we have symmetrical triangles. These patterns form when the price consolidates within converging trend lines. An upward sloping trend line connecting the lows and a downward sloping trend line connecting the highs. Symmetrical triangles can break out in either direction, so it's important to pay attention to other indicators and market context to determine the more likely direction of the breakout. Now here's how you can trade triangle patterns using Heikin-Ashi. Look for a strong breakout candle. Ideally, a green Heikin-Ashi candle with no wick on an upside breakout, or a red Heikin-Ashi candle with no wick on a downside breakout that confirms the breakout direction. This is your signal to enter a trade in the direction of the breakout. Now let's talk about two patterns that often signal a continuation of the existing trend: flags and pennants. These patterns are like little pit stops in a race car's journey. They represent a brief pause in price action before the main trend resumes. Let's start with flags. A flag pattern looks exactly like what it sounds like: a flag on a flagpole. The flagpole is the initial strong move in the direction of the trend, and the flag is a period of consolidation that slopes against the trend. For example, in an uptrend, the flag would slope downwards, while in a downtrend it would slope upwards. Pennants are similar to flags, but instead of a rectangular consolidation pattern, they form a small symmetrical triangle that resembles a pennant. The key takeaway from both flags and pennants is that they typically indicate a high probability of the trend continuing in the same direction after the pattern completes. So, how can you trade flags and pennants using Heikin-Ashi? Look for the price to break out of the flag or pennant in the direction of the original trend, ideally with a strong Heikin-Ashi candle that confirms the breakout. This is your signal to enter a trade in the direction of the breakout, as the price is likely to continue moving in that direction. Alright, let's talk about support and resistance zones and how they work with Heikin-Ashi to identify potential trading opportunities. Now, you might already be familiar with support and resistance, but as a quick refresher, support is a price level where buying pressure is strong enough to prevent the price from falling further, while resistance is a price level where selling pressure is strong enough to prevent the price from rising further. Think of support as a floor and resistance as a ceiling. Now here's where Heikin-Ashi comes in. Because Heikin-Ashi smooths out price action, it can make it easier to identify these key support and resistance zones. Here's how it works. Look for areas on the chart where the price has repeatedly bounced off of in the past. These are your potential support and resistance zones. When the price approaches these zones, pay close attention to the Heikin-Ashi candles. If the price bounces off of support and starts to move higher with strong green Heikin-Ashi candles, that's a bullish signal, and it might be a good opportunity to enter a long trade. Conversely, if the price reverses at resistance and starts to move lower with strong red Heikin-Ashi candles, that's a bearish signal, and it could be a good opportunity to enter a short trade. The key takeaway here is that support and resistance zones combined with Heikin-Ashi candlesticks can provide valuable insights into potential price reversals and breakouts. So there you have it. A breakdown of some of the most powerful Heikin-Ashi patterns and strategies. Remember, Heikin-Ashi is an incredibly valuable tool for traders of all levels. But keep in mind that no trading indicator is perfect, and it's essential to use Heikin-Ashi in conjunction with other forms of analysis, such as price action, volume, and other technical indicators. Don't forget to practice using Heikin-Ashi on your own charts. Test out different strategies and see what works best for you, and as always, manage your risk responsibly. I'll see you in the next video.